And we are very privileged and honored to have a rich panel with us today. And we'll go straight into introducing our very esteemed panelists this morning. Just to note that the chat box is open. Please type in your question there. We shall handle them as we go along. We also have a standby team here at Cdsc who will respond to your queries in a real-time manner. So feel free, type in everything. I'm sure we'll also be provided with a link to the website where we have additional material where you can just check and familiarize yourself with the content of the conversation we are having. So I think this is now maybe the fourth or the fifth of a series of webinars we are having on this subject of securities. And for those who are new to this conversation, by securities, we want to concentrate more of shares and bonds that are traded on the Securities Exchange. And that is what we intend to discuss this morning. And so please feel free to interact with the panelists, feel free to post your questions, feel free to give your comments and feedback. Towards the end of this conversation, feedback will pop up for you to kindly give us your thoughts on the webinar and how helpful you will have found it to be. So please, when that pops up, take 10 seconds or thereabout, and please give us your responses. And so this morning, again, we are honored to have Mr. Paul Mwai. Paul, as many of us will know, is the CEO of AIB Axis Africa Limited, which is a leading stockbroker in Kenya. And obviously, Paul has a very lengthy experience, over 25 years in the financial services industry, where he has done fund management and investment banking. He's worked with various departments in the Barclays Group, which now includes the Barclays Merchant Finance and Barclays Dealing Center, before he joined the Barclays Trust Investment Services Group way back in 1998 as a fund manager. He moved to the Old Mutual Asset Management following its acquisition by Barclays Trust in 2002 as a senior portfolio manager. And Paul joined AIB in February of 2012 from African Alliance Investment Bank, where he had been the chief executive of the asset management company. Paul also is the current chairman of the Kenya Association of Stockbroker and Investment Banks, and is also a director at the Nairobi Securities Exchange. Paul is member of the Institute of Certified Investment and Financial Analysts, ICIFA, and is also a certified trainer in corporate governance with the Center for Corporate Governance. And so, Paul, I will ask you to say a brief hi and just tell us what AIB Axis does and why you are excited to be with us this morning.
Thank you, Hilda, and thank you for the opportunity to participate in this webinar. As AIB Access, we are particularly excited by this new innovation. For a long time, we've been reading in the international market about short selling and being able to go short on the market, and we have not been able to effect that knowledge in this market. So we would like to congratulate the Cdsc for perhaps bringing what has been going on in the international market to the Nairobi Securities Exchange, and giving us the opportunity to effectively apply our full investment knowledge in this market. Thank you.
Thank you, Paul. Another exciting participant for us this morning is Einstein Tihanda. Einstein will confirm to us whether he's in the fourth or fifth generation of the famous Albert Einstein, but our Einstein this morning is the CEO of ICA Lion Asset Management Limited, and he obviously has a BSc degree. Clearly, you followed the line of your ancestors, but in accounting and finance from the USIU, and a master's in management and organizational development from the same university, and also a master's in finance from the University of Strathclyde in the UK. Yeah, an apple does not fall far from the tree, Einstein. So Einstein, just say hi to us this morning and just tell us with your experience in investment analysis, research, and fund management that spans over 22 years, what do you feel this morning brings on the table?
So thank you very much, Hilda, for that introduction. I'm grateful to be here this morning for this webinar. And I think from an investment perspective, what we've been looking for are opportunities on how we can enhance investment returns for the portfolios that we manage. You know, as fund managers, our clients have high expectations of us in terms of the delivery of investment returns. And one of the challenges we've always faced over the years as the market has grown, or rather as the funds and the management have grown, are the investment opportunities. So I think as we grow, the sophistication of the market is important. As in a highly globalized investment environment, the client expectations are also high. So innovation is very important for us in terms of being able to offer our clients a broader spectrum of investment opportunities. So I'm glad to be here as a panelist, but I'm also here to learn so that we can be able also to understand what these innovative ideas are, and to give a fund manager's perspective, so that at the end of the day, we have an enriched engagement, and we can be able to go back and be able to present these opportunities to our clients. So I'm glad to be here this morning. Thank you.
Awesome, awesome, Einstein. In fact, I think we are all very glad to be here. I think we will all learn something from each other. I think they say that you learn something new every day. The lady in the panel, Florence. Florence Juba is the head of investment services at the largest group by capitalization in Kenya, Kcb. Bank Limited. She's a banker of more than 18 years with finance and management experience, and has obviously developed an expertise in financial services, primarily in key leadership positions at the Kcb Bank in Kenya. So beyond your rich experience, Florence, you're a member of Women on Board Networks. Talk to us about that, and even talk to the ladies here who I think at some point we may want to feel like shares and securities is a man's world. I think we'll also talk to the men, and also most importantly, encourage the women to take on the mantle of investing in this very enticing and exciting investment. Florence.
Thank you, Hilda. Good morning, everybody. Very happy to be a part of this webinar, to be able to, discuss and see how we can be able to support investors to be able to take part in the securities lending and borrowing transactions. As Einstein and Paul have mentioned, this is an opportunity to enable our investors just make extra returns and, achieve their objectives, in a very innovative way. So we are really happy to be a part of this process and to be able to play a key role to ensure that our clients and all investors in the market do not miss out, because we are able to support the processing of those transactions and ensuring at the same time that their securities and assets are fully safeguarded at all times. Thank you.
Awesome. And I think it's important that you brought that last point, and I think we shall discuss more about it, that the securities, the investments are safeguarded at all times, even as we lend them out, even as they get borrowed. I think we will see how very stringent measures have been put in place to ensure that securities are not lost, your investments are not lost, they remain safeguarded at all times. And that's a point at which I would like to bring in Timothy Wamboi, the Group Investment Manager at CPF Financial Services. You'll talk to us a little bit more about CPF Financial Services, and seeing that you're a seasoned portfolio manager with over 15 years of experience. And obviously, Tim, you have a Bachelor of Commerce in Finance degree from the Kenyatta University. And you're also a certified investment and financial analyst with CC, that is the Chartered Institute of Securities and Investments, as well as a trade professional portfolio manager with the New York Institute of Finance. So we have quite a bit of both local and international experience and education with our panel this morning. Tim, tell us a little bit of what you think this morning portends for us.
Thank you, Hilda, for that introduction. I think we're looking forward to this session today, especially as CPF Financial Services. We have about 60 billion in funds, and what you witnessed over the last couple of years, 10 years or so, is that fund managers will keep showing you top 10 stocks over and over and over and over and over, doing absolutely nothing with those stocks. So I'm very excited because the SLB gives us an opportunity for fund managers to really, even if they're doing nothing with those stocks, at least they can lend them out and earn something, especially as the market drops. So really excited and looking forward to this interactive session. Thank you so much.
Thank you, Einstein. I think we've heard what you guys have been doing, and so I think we are here, all of us, to see those opportunities that are there, both in the top 10 and beyond. So I think let's sit put and learn from each other at this moment. I want to introduce my colleague, Jesse Kagoma, who is our head of finance at procurement at Cdsc. And he's obviously responsible for providing technical and professional leadership in the planning, development, execution, and evaluation of financial policies and systems within Cdsc. And Jesse holds a master's in business administration, finance, and bachelor's of business management, again in finance and banking, and is also a certified public accountant. Jesse is a seasoned and accomplished business manager with over 18 years experience in strategy, execution, management, financial administration, and the list goes on and on. Jesse, I will ask you to introduce yourself and offer you this opportunity to dive into your presentation.
Thank you, Hilda, and thanks for that introduction. And good morning, everyone. Basically, we're going to look at SLB and how to make money in this product. We'll basically look at instances in the last 1 quarter where investors, both the borrower and the lenders, would have made money. I know in Kenya, we mostly concentrate with the bull market. That's when the prices are good and everything is looking up. But we also need to look at the bear market as well. So SLB is trying to bring the conglomerate of the two, where investors can make money both in the bull market and in the bear market. So that will be the discussion, and we are looking forward to have you and discuss the investment opportunity in Q1. Thank you.
Thank you, Jesse. So just continuing with you, so you are telling us that there's an opportunity for us to, I know when in the bull market you sell, and when in the bear market you sit and stay put, and I think that's where you are telling us now, when it's in the bear market you lend, you don't just sit quiet. So if you have a presentation, I think you can put it up for us now so that we can understand those numbers. And then our panelists, Paul, Einstein, Florence, and Timothy, will then be able to interact with those numbers. Jesse.
Thank you, Hilda. Thank you and welcome, everyone. Now, I'll take the next 20 minutes or so to discuss the investment opportunity in security trading and borrowing. And basically, I'll also look at the Q1 2021 and try to bring out the investment opportunities that existed in the market at that time. First, I think it's always good to try to describe the product because I know there are some people who are joining us for the first time, and it's good to make them understand what we mean by securities lending and borrowing. So securities lending and borrowing is a temporary transfer of shares from one party, refers as the lender, to the borrower with an agreement to return the shares either on demand or at a future date. So the lender can be anybody, an individual or an institution that has been holding substantial shares on long-term basis. What I need to describe here is when we talk of the lender is a conservative investor who hold securities for a very long time, and they wait for the corporate action at the end of every year or periodically. For the borrower is someone who want to try to make money when the prices are going down. As I said, we are trying to normalize making money both during the bull market and the bear market. So when the prices are going down, investors shy away from the market. But what we are trying to do now, the product is coming in to make sure that investors, when the prices are going down, they can also make money, both for the conservative and the risk investors. We have this product worldwide, and it's big. Looking at the revenue that's we are looking at global markets. We're looking at the global revenues. The global security finance industry revenue as at February 2020 was $606 million. That's a huge in comparison to other markets or other investments. And when we look at February 2021, it was $631 million compared to 606 for February 2020. That's an increase. But in January this year, it was $803 million. That was February, so it was just a sum of quite a significant amount. But at least we can say it was a good start of the year for security lending and borrowing. Now, when you look at the broker-to-broker activities, where brokers and dealers lend and borrow security from each other, you can see it has been on an increase. So this year alone was $283 million, and it was an 8.9% year-on-year increase. So what we are trying to tell the market is, whereas in the African continent we have the few countries, Nigeria, Egypt, South Africa, and now Kenya, worldwide, when you look like in the Northern America, it's big in security lending and borrowing. So what we are trying to bring into the Kenya market is to try to bring all those investment opportunities that are out there into our equity market, so that we can expand our market and make more money from this market. Now, I'll take us through the how a lender make money in security lending and borrowing. As I said, a lender is someone who is holding securities and is not intending to sell in the near future. But all what he waits at the end of the financial year or any periodic any quarterly or after every 1 year is the dividend or any other corporate action that will come to those securities. Now, we are trying to say that the security lending and borrowing can give an additional income in what we are calling the lending fee for lending out those securities to other people, in addition to the other corporate action that the lender will receive. So, for example, if an investor was to trade 1 million shares that are trading at 38 shillings at NSE for a period of 30 days at a lending fee of 8% per annum, then this will be the economics of this commercial model that we are using in the Kenya equity market. So looking at the price of those shares when the lender is lending them out, we are looking at the 1 million shares by 38 shillings, that's about 38 million. And lending rate, what the lender expects at the end of the contract period, will be 8% per annum. But in this case, he's lending out for only for 90 days. So we will take now 8% of the prorate to those 90 days, and we get a rate of 1.9726%. So the gross lending fee to the borrower is about 749,588,000. So out of that, we have what we are calling the SRB Leading Commission. This is what will go to the SRB CDS, or those who have been appointed to do SRB and Cdsc as well. It will be about 16% of that 749, which will be 119,934. Out of that, the lender will get at the end of the contract, which is 90 days, 629,654. So looking at that kind of return, if we prorate this for 1 year, or if the lending was for 1 year, we can see that the lender at the end of it will get 2.5 million net at the end of the year, which is specifically 2,553,600,000 net at the end of the year, which is about 6.7% of the 38 million securities that he's holding. So if you look at that, this is an extra income that the lender may not have, and if they had not lent out these securities. So if you look at the 6.7% earning in their investment from the security shares, is actually comparable to someone who had deposited some fixed deposit in a bank and earning about an average rate of 8%. Because when you earn an 8% in the bank, you get about earning about return of about 6.8%. So the 6.7% return from the securities is comparable to what you earn from a fixed deposit, which is about 6.8%. That's why we are saying it's a good investment. It's an investment that can give you an extra income with the asset you are holding. And the asset you are holding, I'm calling them the shares you are holding in your balance sheet or your statement of financial position. So those, you don't have to only wait for the dividend. You can also make extra income when those securities are being lent out, in addition to the dividend that will be accruing to you from the issuing institutions. Now, we also need to look at the borrower. The borrower is a complex investor. This is a person who comes to the market with the expectation of the prices to go down. Just like the way in the current secondary security market, equity market, an investor will come to the market with the expectation that the prices will go up. Now, for SLB, an investor will come to the market with the expectation that the price will go down. Okay, so he will be happy when the prices is going down. And as you will see in the next slides, you see there will be fluctuation between the prices going up and down for quite some time in the last one quarter or in this quarter. And you can see where the investors or the borrower would have made money if they had come to the market to borrow the securities. Now, looking at the model, the commercial model for the borrower. Now, looking at the same security that were lent out by the lender, the borrower borrows them when the security were trading at 38 shillings. So the borrowing cost will be looking at the cost, which is the lending cost at the beginning of those, that is accrued to the lender at the end of the contract, plus what we are calling the borrowing SLB commission, which is 0.55%. Of course, we have to prorate to 90 days over 365 by 38 million. Therefore, looking at the total borrowing cost, we are looking at the 749,589, and this figure is familiar from the lender. This is what actually goes to the lender, plus now the cost of borrowing, which is like the interest on this borrowing. But in this case, it's a security. So is cost of borrowing this security will be about 51,534. So basically, 51,534 is what we are calling the 0.55% as the borrowing SRB commission. Remember, the 749,589 is market determined, it's not fixed. What happens in NSRB market, the raider bring or rather request for a certain rate, a lending rate. In this case, the raider requested for 8% and the borrower is willing to pay 8%. The amount or rather the lending rate could be lower or higher. The raider may request for 2%, 5% or even 10%. Now, if that matches with the borrower, what the borrower is willing to borrow at, whether it's 2%, 5%, 8%, or 10%, then the matching will happen and the trade happen. So in this case, we have used an 8%, and it's not a fixed rate, it's a market determined rate. Just like the way today, if you go to the security market or the equity market at MSC, and you want to buy securities, you give an order and you say, I want to buy this particular security at 20 shillings. Now, the other side, the seller will come and also bring the security to the market to sell, and they're also looking for at 20 shillings. So when those two matches, then the trade happens. So the same case here, the price in the SRB market will be the lending fee. What the borrower or what the lender is willing to lend the security and earn from the market. If that matches with what the borrower is willing to borrow the security, then the trade happens. Now, if I go now to the illustration below, should the share price fall by 3 shillings, for example, to about 35 shillings, then the share amount, which will be the borrower, the amount that he will spend to buy back the securities to return to the lender will be about 35 million. So what happens, the borrower will borrow the security and the price is high, then wait for the price to go down, buy back the security, because the moment they borrow the security when they are high, they immediately sold in the market, okay, to capitalize on the high price. Then they wait the security prices to go down. In this case, we are saying 35 shillings, then he buy back the security. So in actual sense, when he borrowed at 38 million, which that's when he borrowed and sold the security in the market, he has now used 35 million to buy back those securities to return. In actual sense, he has now earned a gross profit of about 3 million. So out of these 3 million, we have now to less these are the costs that are associated with SRB. And one of the costs is the 801,123, which was the total borrowing cost that was above there. Then remember, when the borrower bought the security, he sold to the market. So they incurred a transaction levy in the market. And in this case, we're using an 1.8%. We know there are some arrangement, people pay less than 1.8%. And at the time of buying back the security, he bought securities worth 35 million at 1.8%. So in other words, we are saying their profit will be the 3 million minus these other costs, which will be about 884,877. Now, at the beginning of the contract, when the borrower is coming to borrow the securities, he brought in collateral, which is 110%. And in our previous webinars, we explained why it's 110%, because this is supposed to cover the fluctuation in prices of the securities. This 110% security, this is 100%, which is 38 million plus a 10% over and above to cover for fluctuation in the market. So he will have brought in a collateral of 41.8%. Now, this 41.8%, we are fixing this, or rather, we are investing this 41.8 million into a core account where it's earning about 6% for this case. And in those 90 days, the amount of interest that the borrower will earn from this cash collateral will be 618,411. So in total, the borrower at the end of the contract will earn 1.5 million. Something I want to say about the collateral. In other SMB market, for example, in India, you don't earn interest when you deposit your collateral to borrow securities. But we are looking at something that will work in our market. So we are making sure that when the borrower comes to the market, borrow security A and go and sell in the market at 100%, then he gives as, or rather he deposits 110% collateral, out of this 110%, it will still earn him interest. Now, if you look at the two, he brought in 110, he took security worth 100%, and therefore the only amount that's being tied in this transaction is only 10%, because he brought in 110, he took 100% and sold in the market. So the only amount that's being held in this transaction is only 10%. But the 10% will also earn interest in addition to the 100% that he deposited as collateral. So for the borrower, at all the time, he's making money. When he borrows and uses security to sell in the market and do other things with the money, or even trade in other securities and make more money with many other transactions, and when the security is held with us, he's still making money with it. Now, something else we need to insist here. The borrower, during that contract period of 90 days or even 365 days, he can do as many trades as possible with the money that he sold the security at the beginning. So provided at the end of the contract, he will come to bring back, to buy back the security to take back to the lender. Hilda for the next discussion. Thank you.
Thank you. Thank you so very much, Jesse, for those very, very excellent illustrations. I think we are able to concretize exactly what it is, what it means when you say that you can make money by borrowing and lending securities. I think we have seen a very clear demonstration of if you're an investor and you hold about 1 million shares whose share price is currently at 38 shillings, then it means your current portfolio is about 38 million. And we have seen if a borrower, a strategic borrower, borrows those shares today, and the share price in a month, in 2 months, in 3 months' time drops to about 35 shillings, which is a very real and possible scenario, then obviously by the time they are required to bring back your shares in 90 days, they will buy them at 35 shillings, yet they borrow them when they were 38 shillings. And I think we've also understood that when I borrow, I think the strategic the strategy there for me is to borrow and sort of sell them, so that then I can have the 38 million I'm targeting to make better use of. And then in 90 days, I think we are very clear in understanding that I, as an investor, I will expect to get back my 1 million shillings. So for the borrower, I think the opportunity, Jesse, you've demonstrated is that I will get 38 million from the shares I have borrowed from you. And when I'm returning them to you, I'll only spend 35 million shillings. So I'll make a gross profit of about 3 million and deduct a few other expenses here and there that you have spoken to us about and demonstrated. And so I think that's a very competent strategy that I want our panelists to interact with. And of course, I will want to start with Einstein and just ask you to lend your thoughts on that very insightful demonstration. You represent, obviously, the investing community. You, I think, hold a very large portfolio that would constitute the lenders side. And we've seen Jesse telling us that you could lend securities and make about 250,000 in a month's time, just and you get back your shares. So in addition to you not losing your shares, you'll also make some additional money. And so Einstein, what are your thoughts exactly on that particular illustration?
Thank you, Hilda. And thank you, Jesse, for that very insightful presentation. I liked the illustrations because I think they present a very clear picture about how the dynamics of the borrowing and the lending. And for me, what I see is obviously from the portfolios that we manage as fund managers, we have clients, for whom we hold equities on their behalf. And I think for me, what I see is an opportunity to make returns at a time when there's hardly any movement in the equity portfolios unless you're making major decisions. And of course, in our market right now, we trade on very few counters. I mean, for various reasons, including liquidity and many other factors. So for me, what I see is certainly an opportunity to maximize on the equity holdings that we have for our various portfolios and our clients, and certainly an opportunity to make some returns in an instrument that you would otherwise not have made returns. I mean, I look at it from the point of view, the reason you hold equities is primarily for capital gains and for dividends. But what it also means now, there's a third stream of income that one can be able to earn from lending as an investor. So I think this is certainly a very insightful presentation, and it gives insights as to how you can be able to maximize on this portfolio that we hold on behalf of our clients. And I think the comment I would make is really about investor education and awareness, because I think it will be very important for us also to engage our clients. At the end of the day, we manage these portfolios on behalf of our clients. So I think this is, I see this as very insightful and certainly presents a significant opportunity.
Indeed, Einstein, and I think you've introduced a very good point about investor education. And I think what you've highlighted to us is that this is additional income without you losing your investment, without you having to sell it, in addition to the dividend that will come along as you hold your portfolio. So I think it's critical that you brought up the issue of investor education, because of importance is to highlight these opportunities to the portfolio holders, that in addition to you not sitting with your asset, there's an opportunity for you to sweat it and just get something out of it. You can essentially get more with what you have, rather than just having your assets just sit there and not give you any additional income, rather than the little dividend that will accrue every year. And sometimes we see some counters or some shares don't even declare dividends. So, so when you are able to lend, and when a borrower is able to borrow your securities, then there is the opportunity there for you to make some money during that period. And I think I want to ask our team to just interact with that thought right there from the perspective of institutional investors. So Timothy, we know that you could earn a lot of commissions, lending commissions, as Jesse has demonstrated. And I would also like you to play a little bit of devil's advocate, and just in addition to giving the rosy side of the 8%, there's also the opportunity that the lending fee could be something less. And also there's the reality that, I mean, this is a risk, an investment like any other. It has opportunities, it has risks. So I think for you as an investor, the comfort is that when you lend, the only risk you will run is earning less lending commission than what you could have earned if it was at 8%. But it's the assurance that you will earn something nonetheless. Tim.
Thank you, Hilda, for that. I think, yeah, for us in the pension industry, we are really excited about this because aside from stocks lying idle, when the markets are coming down, there'll be some mitigating factors with regards to the return that is earned from the stocks. I think really for us is to talk to our fund managers, and I know many products have come into this market of ours, but they failed to take traction with the pension industry because there was no proven, players globally on most of those products. But for SLB, I did check it out, and I saw 2% of all SLB transactions globally involve pension schemes. So it's a good case for us, Einstein and the team for fund managers. And really, like we've seen from Jesse's presentation, yeah, there is a lot to be gained. Yeah, I've read somewhere that we received over, about 10 billion shillings was made in 2019, up from 800 billion shillings in 2010. These are just revenues from SLBs earned by pension schemes. Okay, and I also realized that about, I think, 87% of all pension schemes in the US participate in SLB transactions, which really for us, our CPF Financial Services, as we talk to our fund managers, we shall try and prove to them that really it is not something that is to be scared of as pension schemes. I know other products in the market, pension schemes don't engage in them much, but for this one, I do know that there is precedence elsewhere for us to really embrace, SLB. I do know there's some bit of jitters when the Japanese GPIF banned lending of securities. So most pension schemes were a bit scared. But nevertheless, the proponents of SLB stuck and said you still can make money, when you lend out securities, and that is what really we are discussing with the fund managers and telling them, hey, even if Elon Musk is against short sellers, I still believe there's something that there's some returns that can be earned, like you said, once we embrace short selling. Indeed, the World Pension Council, WPC, has really gone out to push pension schemes to really lend their securities to for onward, short selling. So I think, there's a lot of fees to be made, which will mitigate when we are experiencing a bear run like we've had for the last, I think, 4 years in Kenya. SLB will really come in handy. Thank you, Hilda.
And I think when the pension schemes earn the money, it cascades down to the pensioners. I think when it comes to our retirement planning, I think then that portends a very good opportunity for us even to consider having our pension plans with the likes of CPF Financial Services, because then you're already demonstrating to us how you're able to grow our pension funds.
Yes, indeed, yes.
Exactly. And Florence, you are the link between investors and fund managers and pension schemes. And obviously, we are excited that Kcb Investment were the first custodians to get on board as an SLB agent. Talk to us a little bit what opportunities you saw that convinced you that indeed it's the right time for you to get on board.
So thank you, Hilda. I think we've had and seen the opportunities which are available from the presentation from Jesse, and also following through from what Einstein and Timothy have talked about, both from the perspective of the investment manager and the perspective of the client, in this case, a pension scheme. As custodians, we hold assets for institutional investors mainly, such as collective investment schemes and pension schemes. And therefore, once our clients or the fund managers have decided where the investments need to be done, then we come in and we ensure that we are able to process those transactions. So as custodians, it is key that we are appointed as SLB agents to be able to do the processing of these transactions once the opportunities are identified. We've seen, from Jesse's presentation, once for example, the pension scheme wants to lend their securities, as the custodian, we will come in as an SLB agent and avail those securities to be lent, ensure there is adequate collateral that has been received to cover those securities, and on a day-to-day basis, and monitor the value of that collateral and the movement of those securities to ensure that our clients' investment is fully covered. If there are additional margins to be put in, ensure those are called for, and maintain and ensure that the customer who is lending those securities is fully covered at the end of the day. Of course, also we've seen their corporate actions that are that are happening while these securities, are out on loan. Therefore, as a custodian, another key role we will play is ensure that we keep track of these corporate actions such as dividends, bonus issues, monitor those entitlements, and ensure that when that contract is being closed out, we are able to collect and ensure that the parties or the customers we are representing receive their full entitlement. The other thing we've seen from Jesse's presentation is that there are commissions that are going to arise and transaction levies. So it's a win-win situation for both the client and the market participants when we sign up as SLB agents. Yes, so those will be my comments on that, Hilda.
Excellent comments, Florence. And I really like that you have highlighted the fact that it's a win-win situation for both the players and the investors. And I think I want Paul to speak more into that point, because Paul, you are among the pioneer central depository agents and stockbrokers who got on board and signed up as SLB agents very, very early, way back, I think, last year. And you could just talk to us about the advantages you saw right from the beginning for yourselves and for your clients. What did you see that the SLB has potential and capacity to do? And I think I also want you to speak to that investor or trader who is wondering, why would I borrow shares and pay in 110% margin collateral? Well, I could just buy the shares or spend that money else in any other way. Paul.
Thank you, Hilda, and thank you everybody for that very useful contribution. I think in as far as the benefits of SLB, we've already spoken widely about the benefits to the lender, which is the additional income. We talk about the total return, and Einstein has highlighted that your return is capital gains, dividend, and now you have an additional return. Maybe just to re-emphasize that the importance of compounding that additional return that you're getting is really what will make perhaps the difference between one fund manager and the other. Because where your total return on a share was 10%, 4% or 13%, you're then able to move that up significantly. And that's really the value add that you're looking from somebody who is advising you on your investment. That gives the value add. In as far as the borrower is concerned, I think there is an opportunity. And previously, as an investor, you could only make money when the price rises. You could not make money when you expect the price to fall. So if we take an example, and I know Jesse has shown some example, but perhaps the one that comes to mind immediately is Nation Media. Nation Media recently announced a share buyback of 10% of their shares, and the share price went up about 70%. So from a research perspective, you're asking yourself, this is the same share, same assets. Does a 10% share buyback justify a 70% increase in the price? And if the answer to you is no, yet you don't hold any Nation Media shares, then the option you have is to go into the market, borrow the shares, sell them, and then buy them back when the price has gone down. So Nation Media went up to 25 shillings, it's now back to 17. Had you taken that position, and I think this was just in the last few weeks, you would probably be looking at a significant return way above whatever cash collateral you have put and way above any expenses that you have put. Maybe also going into the international market, we had a case of Nikola, which is a company that makes electric trucks. I think it is the combination of trying to mimic Tesla. There's Nikola Tesla. And, the company's price was going up. One of the fund managers decided to do a research on the company and found out that perhaps the price was not justified, that the price had been unjustifiably pushed up. And therefore, they decided to short the market. And that's when perhaps the whole idea about that particular share came up, and they made a lot of money. So, I mean, there are many examples of where you have done research and you have proven that the price of the share is unjustified in as far as how high it has gone, but yet you don't have the option. So this gives us the option to do that. On top of that, there are benefits to the industry, mainly in terms of commission to us as agents, commissions to our to other agents who might also bring clients to us, commissions to the Cdsc, and the whole industry in general. But perhaps the bigger benefit comes to the entire industry, particularly because of improved liquidity. When you're buying and selling, the more you're buying and selling, the better the liquidity of that share. So you will have more transactions in Safaricom. So as a seller of Safaricom, you have more opportunities to buy and sell. And this also then takes us to the point where, you know, as participants in global markets, Kenya is classified as a frontier market. Now, to move us to an emerging market status, which is perhaps what we aspire to as a market, we would need to first improve the liquidity of the market. And number two, provide alternative products such as the SLB, which will then make us ranked higher in as far as the market. And that will attract more international flows into our market. So there is again a benefit there. But perhaps the final benefit I'll emphasize is that it improves price discovery and the market efficiency. So for example, if the share price moves so high, there will be people who will be coming to short the market, and therefore will stop the share price from being going way beyond. And also on the other way, when the share price is going down, there will be people who will step in to stop it to go way below. So price discovery will be much more better, will be much better, and we will have a better market. Thank you, Hilda.
Thank you, Paul. Those are indeed very, very insightful thoughts. When you think about the whole range of the possibilities in the SLB, like we said at the beginning, it's a win-win situation, and I think Florence who's highlighted that it's a win for the investor who is holding the long-term portfolio because you get to earn something little. It's a win for the borrower because you get to make money on shares that technically do not belong to you. It's a win for the agent, I think Paul and the rest of the SLB agents, because you get to make a little money. So I think it's really an opportunity for us to think outside the box, as it were, and just really make a lot more with what we have currently, which would otherwise be sitting idle. And I think I want to ask Jesse to even just highlight further, in addition to those benefits, Paul, that you have spoken about. Jesse, I know there are a number of risks that, of course, associated with securities lending and borrowing. You could briefly highlight to us how some of those have been mitigated, especially within Cdsc and the regulatory framework that we have put in place to be able to introduce SLB in Kenya. And in the same spirit, is there a specific SLB account that an investor needs to open to be able to participate in SLB? And I think there's also a question on whether there are any specific listed or quoted shares that must participate in SLB.
Thank you, Hilda.
Or are there any designated shares or quoted securities that are the ones that are designated to be able to participate in SLB?
Thank you, Hilda. I'll start with the risk and the mitigation that we have put in place so that we make sure that these products, the risks are minimal. And one of them look at the credit risk. Some of the issues that will come up as far as the credit risk are concerned is when the borrower failed to provide collateral or rather failed to avail security at the beginning of the contract. So that the borrower has to provide before the borrowing request. So that has been taken care of. So there will be no time that transaction will happen without the provision of the collateral by the borrower. So that has been taken care of. The other risk is the borrower failing to deposit the additional margin call. So when the prices goes up and the collateral that was brought is less than what we are holding, then Cdsc will do a daily mark to market of their security, and there will be a margin call when the prices goes above the collateral that's being brought by the borrower. So that will be taken care of by that. So what about when the borrower failed to deliver security at the end of the borrowing term? Now what happened, because we are the custodian of those securities, we practice what you call the buy-in, and we give a cash equivalent compensation for failed return of security paid by the collateral provided by the borrower. So in this case, because we have the collateral, there will be no time that the lender will lose the securities, because we have the cash and we can do the buy-in, or if those securities are not available, we can return the cash equivalent. So what about when the borrower failed to settle the outstanding lending fee at the end of the contract? Remember, Cdsc is also holding a settlement guarantee fund in place that will take care of the lending fee in case the borrower fails at the end of the contract. Those are basically the credit risk. There are also some liquidity risk, and I'll just go through them very quickly. When the borrower is unable to get securities in the open market, some of these securities may not be available. So for this security product, or rather SLB product, we are looking at only the liquid securities, or that is NSE 2020 index securities, so that we can be able to at least reduce that risk. And if the risk is still there, we still have the cash that allows to do cash settlements to the lender. And what about when there is an inability to liquidate borrower collateral on default by the borrower? The good thing with this, the quality of the collateral required in a security and borrowing transaction is restricted to the cash in Kenya shillings, and this liquid collateral. So that risk is eliminated at that point. So basically, those are some of the risks that you are going to incur, and we are trying to tell the lender that the collateral that's coming from the borrower is taking care of most of these risks that will be incurred, or rather that's probable to be incurred in this trade. Now, the other thing is, what does the investor has to do to participate in an SLB market? Now, we have appointed 6 or 7 agents, and they are all in our website, that are now ready to do the SLB, and some of them have already done some transactions. So those are the people you can go to their office or give them a call, and they will give you a form, a contract to sign, so that now you start trading in this SLB market. So it's a very easy process. And once you get to the appointed SLB agent, they'll be able to loop in, and you sign the contract, and you're able to trade. As we said, we looking at the securities, we are the SLB market will be doing is only the listed security in the NSE 20 share index, because they are a bit liquid, and we will not run into issues to do with unavailability of those securities. And we try as much possible to when the security that are listed in the NSE 20 share, if they changes, now we also do the same, so that we make sure that the risk is minimized. Thank you, Hilda.
Thank you, Jesse. And I think I like that point that we are currently starting with the securities that are listed on the NSE 20 share index. And Paul indeed has talked about the benefit of SLB in the market is to spur liquidity. And so we are saying that while we are starting with those ones that are on the NSE 20 share index, this product, the securities lending and borrowing process, has the ability and capacity to spur liquidity, even in those quoted securities that are not in the NSE 20 share index. And then we will find ourselves that ultimately, in the bigger grand scheme of things, all our securities in our market ultimately become more active. And I think that's the long-term plan, Jesse. Okay, Jesse, I think I didn't get your response on that, but not to worry. I want to speak to Florence and get some joy from you. Are you happy with the mitigation measures that Jesse has highlighted from the risks that this product could portend to your investors? As a custodian, of course, your primary role is the safe custody of your clients' assets. And this particular screen-based model presents opportunities for both buyers and sellers, but also comes with the risks Jesse has highlighted. And do you then believe that the risk measures that have been put in place are sufficient to cover all the risks to a comfortable level?
So thank you, Hilda. I think Jesse has highlighted, the measures which have been put in place in the rules and regulations, as well as the procedures that will be used to govern the processing of these SLB transactions, and clearly highlighted that the risks have been looked at from all angles, from operational risk, from legal risk, liquidity risk, credit risk, and adequate measures put in place to ensure that the processing of these transactions is being carried out in a safe environment. I think he has mentioned that the SLB agents who are all regulated parties are the ones who are only authorized to process these transactions. Again, there are requirements and that they are required to ensure that they're adhered to, and standards that they need to ensure are in place. They need to ensure they have the capacity and the technical ability to be able to process these transactions. I think the other key thing that did not come out is that Cdsc will play the role of the central counterparty and ensure that all transactions are settled, and there are penalties, that will accrue in case a transaction fails. And this, further, entrenches that, and ensures that the risks that may arise are fully safeguarded, and the lenders or borrowers will ensure that they receive what is due to them once a transaction is put in the system and accepted as a transaction that needs to be settled. I think the other key thing we need to mention is that this SLB model is under piloting, and I believe there will be, it is an opportunity for us to pick up some key lessons before we go live and ensure that any other measures that need to be in place are put in place to ensure and give comfort to our clients and to the market overall. Thank you.
Thank you, Florence. Indeed, you're very right to bring up the issue that the current SLB platform is under pilot, and I think that's very important assurance to our investors and clients, because what we are telling us is that we did not just dive into this thing. It was sort of not crafted on paper and we went live into it. I think we have been prudent enough to give about a year of a pilot phase, and which is where we are today, where we are now in the phase of doing this a very elaborate investor education, doing even the onboarding of the agents, the custodians, even speaking to the fund managers, speaking to the pension schemes. So it's a very elaborate process, and of course, even just taking the lessons. Take for instance, even the kind of questions I'm seeing on the chat. What are the tax implications? And these are things we've covered previously, and we plan to go in depth during our next webinar, so that we are very clear that our investors and clients get as much comfort as they can, so that by the time we are all ready to go into lending our securities in the converse of borrowing, then the assurances are that this is something that has been tested and tried in the Kenyan system, Florence. I think that's what I hear you to say.
Yes.
Exactly. And I want to bring in Einstein at this point of the conversation. I think Einstein and Florence, your brother and sister in the custody of investors and clients' assets. From your perspective, do you have any main concerns that would probably need to be addressed? Just as we are saying, we are in a pilot phase. We want to be able to cross all the T's and dot all the I's and hear perspectives from various quarters. What have you heard from various quarters that we could probably need to speak in more depth?
Thank you, Hilda. You're right that Florence and I, in the structure of the pension funds, work very closely. She's the one who holds the assets, and I do the investment management. And if she's happy that the security, the sufficient protection of the funds, then it addresses a lot of concerns. And a lot has been said about the, especially on the chart and the responses by Jesse. Have addressed a lot of the issues that I would have talked about. So I don't want to delve too much into that. The one thing I want to talk about is really from the comfort of the client perspective, especially when you're talking about the pension funds. The key question they would likely to ask is, does the regulator support this? And by regulator, I mean the Retirement Benefits Authority within the investment guidelines. Is that allowable? And why this question is important is because the investment policy statement that guides how funds are invested for pension funds are derived from the investment guidelines that are issued by the Retirement Benefits Authority. So I think that is a key area that I think from an investor education perspective would need to be addressed, because once that is sorted, then it means that we will, because each scheme has its own investment policy statement. And from an implementation perspective, it's really now to ensure that that particular aspect of security lending is allowable in the investment policy limit guidelines and investment policy statement. So you need to work with the actuaries and anyone and all the professionals who are involved in developing that investment policy statement, so that it can actually now be workable and implemented, and it can actually be able to enable the pension schemes to actually lend on their security. So I think the other issues are things I think we can be able, these are related to the dynamics and the risks, and I think those we can be able to address. But I thought I should highlight that particular issue.
Awesome. And I think that's great that you bring that to the fore. We know that the Retirement Benefits Authority has actually issued a no objection to yourselves to participate in this. So I think you have preempted, and I think we also did preempt that particular concern coming. And so we very honored the initial stages engaged the RBA, and they were able to give an objection to participation. So just to the comfort, like you have said, to the comfort of the clients and the investors and even the participants, the fund managers and all the other professionals who would be the ones to participate. I think there's some comfort in that the Retirement Benefits Authority is firmly on board. And we've already opened the door and avenue for that to have that enhanced conversation with your regulator. And I think I would want to bring in Timothy at that exact point, because we'd like to hear from him from the perspective of the pension schemes. How does SLB compete? Does it compete favorably with the other investment vehicles? We know that there are so many investment opportunities and products for pension schemes. In your opinion, do you think SLB ranks among the competitive ones?
Thank you, Hilda, for that question. I think I would like to agree that it does compete favorably with other opportunities, especially because that rate you're talking about, the lending rate of, in the example used by Jesse of 8%, is being a market determined rate. It means if I am to, as a pension fund, if I am to lend out my securities and I'm earning some fees on top of this, or on top of it, which is market determined, then it would rank at the same rank with the things like deposits, fixed deposits, So yes, I agree. It does rank well. I think just to highlight the question you asked me earlier, how to create awareness. I believe that's where it begins with the fund managers themselves. They have to embrace these products. I know they understand it very well. It's just a matter of embracing it. And once they embrace it, the next step will be for them to talk to the trustees of the schemes, being the final decision makers, and being the fact that they may not be very conversant with the technicalities of SLBs. Then the fund managers, as they do best, they would explain this to the trustees. And once you have the buy-in of the trustees, and I'm glad to hear that RBA issued a no objection to this. So the whole industry, including Cdsc, including CMA, RBA, would organize webinars specifically targeting trustees. After the trustees have accepted the SLB as a product, then that's when now we go to the members, and have the members of the schemes appreciate and accept that what the fund managers are doing is for the ultimate benefit in terms of their returns. So in terms of awareness, for me, I believe that's the way to go. And once we have that, pension schemes will really embrace that. I think to come back to your question, what we look at when you're investing, basically we have to look at the return you are getting. And is it commensurate with the risk we are incurring? In this case, we are giving away our securities. Is the collateral enough? Will this person be able to get those shares back? For example, Stanchart, you may sell them. Will you be able to buy them back when time comes? Will you get them back? Right? Are they liquid enough? So once I have been assured that I'll get back my securities on maturity, and then we also look at liquidity. Talked about Stanchart. We also look at income. I think it's clear that even if my securities have been lent out, I will still be enjoying the dividend. So vis-a-vis capital gains, for us as pension funds, if you lend out your securities, I have, in my understanding, I don't see any. If all these other areas have been well fortified, I don't see any risk. You give out your share, you give out your shares. If the price goes down, you make some money. If the price goes up, when you get back your securities, you still make some money. So for me, really, it's a no-brainer, and I think it's a way to go. We also look at time frame, and in this case, I've seen most contracts will be between 90 days to 1 year, which is in line with where we really gauge fund managers every quarter, and every year we look at your performance. So the time frame for the SLBs is quite, good for pension schemes. Tax implications. Glad to hear that there's a question which has been asked here in the Q&A, whether that money that is made, that premium, is it taxable? For pension schemes, I know we are tax exempt, so I don't know if that lending fee really falls under the category of the tax exempt incomes that we earn as pension schemes. So Hilda, with that, thank you so much, and back to you.
Thank you, Timothy. And indeed, you've already sort of done a preamble for our next webinar, where we intend to focus on tax and tax treatment for the SLB income. So I think in addition to the answers that have been given in the Q&A, I think we want to urge our participants to be on the lookout for that webinar when we announce it. And I think I want to thank you, Timothy, and ask Paul whose market it is right now. Paul, in these days of COVID, when many share prices are dropping, is it the borrower's market? Is it the lender's market? And in the same breath, when is the best time to invest in securities? When is the best time to do outright buy, outright sell? Paul, and I don't know whether you are able also to put on your camera so that we can see you as you speak to us.
Thank you, Hilda. Yeah, so yes, I think when the market is in a bear move, that presents the best time for the borrower, because the borrower is borrowing, sells with the intention of buying back. So when the share prices are going down, he's able to buy them back at a lower price and therefore make a bigger margin on top of that. And that's perhaps been the challenge in the past, because you could only make money in a bull market as an investor in the stock market. Now you can also make money from a bear market. In as far as the lender is concerned, I think the best time is effectively any time, because you're able to earn a return that's on top of that of what you're earning. I think Jesse has explained a very robust way in which you can secure your shares, in as far as having the 10%, 110% cash cover, but also the margin call, so that the possibility or the likelihood of having a situation where you have lost your shares or the equivalent in money is extremely low under that arrangement. So that is perhaps what encourages us. So I think, yes, the current market presents very good opportunities both for the lender and the seller. And the challenges have been that there's been a big knowledge gap. For example, we as AIB Access will be looking for borrowing opportunities. We have positions that we would like to borrow, but we don't have lenders out there. So we would like to encourage those lenders out there, please come to the market, because the market is about many people coming to meet and exchange, buy and sell positions. So we would like to encourage the sellers out there to come. I appreciate what Einstein has said, that the pension industry, being the biggest pool of savings in this country, has certain regulatory hurdles that it has to go through before we are there. But I think once those are done, I think we are looking at a very robust market and very good opportunity for investors to make additional return on their investment.
And I think I want to go to Einstein, and because I think we will need to hear from you, because you've been put on the front line by both Paul and Timothy, because then in your closing remarks, how do you propose to bring on board the lenders? Timothy has said we need to speak to the trustees. We know you are the link between the pension schemes and the trustees. Paul says he has borrow positions to take, but the shares are not there to be lent. In your closing remarks, Einstein, what are your final thoughts on this?
Thank you very much, Hilda, and I'm grateful for having been able to participate in this very educative and insightful webinar. I think, yes, we've been put on the spot as the fund managers, and we'll take responsibility for that, because it is upon us to now engage the trustees. I think earlier when I was answering the questions, I think I brought up the issue of investor education, and we need as fund managers to actively engage our clients who are the trustees. At the end of the day, they rely on our professional guidance on them, on enabling them make investment decisions. But at the end of the day, they are the ones who approve. And so I think one of the issues that we need to address is therefore how we will ensure that their investment policy statements are able to capture the fact that that is allowable, And therefore, we need to work very closely with the trustees and the professionals that they engage in terms of developing the investment policy statements. Just to mention, when it comes to developing those investment policy statements, which are renewable after every 3 years, the regulations require an independent professional other than the fund manager to develop that policy statement. So you need to work with the trustees to get them to see the need for that to be incorporated in the investment policy statements. The second thing we need to do is work very closely with Cdsc and other players in sensitizing the clients about this opportunity, investment opportunity. I know a lot has been said about the pilot projects and the engagement with key stakeholders, but I think now it's really also about directly engaging with those trustees, and we have a role as the key link to work with, to engage them. On board, you have Florence as a custodian and representing the other custodians, and we as fund managers. So we understand the whole structure and the instrument. So I think it is now about directly engaging these trustees to see that this is actually an opportunity, and to take them through the practical aspects of it. And so there's a lot of work on our end to do it, and that is a responsibility we will take, because at the end of the day, the background is that assets under management have been growing, but the investment opportunities have been limited. And so we have a responsibility to be able to present these opportunities to our clients to see how they can be able to make use of their investment portfolio to generate competitive investment returns.
Thank you, Einstein. And you mentioned Florence, and I want to ask Florence to give us her closing remarks and just tell us whether you think now would be a good time to speak to your clients to agree to we know that many of your clients are asset rich, but sometimes you find yourself very asset rich but cash poor in some situations. How do you think we could bring them on board, as Einstein and Timothy have said, so that they are able to get something from their rich portfolios?
Yeah, so thank you, Hilda, and thank you, Einstein, for those remarks. I think, as Einstein has accurately mentioned, it's that as custodians, we're a key part of this transaction, because once the clients have decided and the fund managers have decided that they need to effect these transactions, then the custodians will come in and ensure that these transactions are effected as per the client's instructions, and the settlement happens when it's supposed to happen, and the contracts are closed out when they're supposed to be closed out, and it's only a custodian working with the fund manager and the Cdsc and the other market participants who can be able to affect those transactions. So the challenge is on us as custodians to be ready to run and affect those transactions when our clients decide that we need to effect those transactions, and therefore just to challenge the rest of the custodians in the market to take up this opportunity to become SLB agents, so that we are able to, support the market achieve the objectives that the SLB transactions is looking to, to achieve in the market. So thank you. We will be able to support our clients, when the opportunity arises. Thank you.
Thank you. Thank you very much, Florence, even for your assurance and even being the first custodian to sign up. And I want to ask Jesse now to also give his closing remarks. And we've heard the cry of the custodians. We've heard the plea of the fund managers. We know Timothy is just waiting to be told, okay, it's now ready. Let us get running with this. And Jesse, what are your closing thoughts?
Thank you, Hilda. My close remark and my panelist colleagues have, highlighted on most of the issues. And I would just need to highlight on some few things that I've seen in the chat and some of the queries. So some of the things that we need to be aware of, that all agents, and we mean all the SLB agents, will be able to view all the pending lending and borrowing requests because the system allows you to do that. The automated matching of requests will happen according to the criteria of the security, quantity, lending fee that the lender is looking for, and the duration. So after the matching, the security now will move to the lender's CSD account, and the borrower collateral will be brought. Now, that is a point where I see most of the questions coming from. The 110 collateral, it's not, we can't say it's so much. What we are trying to say is the borrower will bring 110% collateral, then you get back the security worth 100%. So he'll be able to sell the security worth 100% to the market, and he'll get his 100% cash. But we are holding his 110% collateral, which is in form of cash. Now, out of this, the 110 collateral we are holding, it will still be earning interest that will accrue to the borrower at the end of the contract or termination of the contract. So the borrower is not holding so much money in this contract. In fact, he's only holding about 10%. Because he took 100%, he brought in 110. The only percent that is being held is 10%, because the rest of the money he was able to get shares and sold at that point. So we can say the SLB market is not holding so much of the cash outlay. It's actually making sure that your cash is working for you. So that those will be my head remarks. And we're looking forward to see many transactions in the market, looking at the benefits that are accruing to both the lender and the borrower. Thank you.
Thank you so very much, Jesse, indeed, and Florence and Einstein and Timothy and Paul for your very distinguished presentations and thoughts and opinions around this. Thank you so very much, distinguished participants who've been able to join us this morning. I think we've had a very interactive session. I think the questions in the chat and the Q&A can speak to the interest that this product has stimulated in the market. We give you comfort that this presentation will be available on our website shortly. I think you've also been able to see the links that have been shared on the chat where you can find additional information on our website. So not to worry, all the questions that you've asked are already summarized into one document with the corresponding answers and additional information where you can find it, this presentation. They will all be available on our website. So I want to again thank you very much for braving the very chilly morning when we started to this moment, and invite you to stay on the lookout. Talk to your stockbroker, who is also your central depository agent, and just ask them if you've signed up for SLB. And if they haven't, then you know where to start off your SLB journey. I think we are very glad that you've been able to join us. I hope you've also participated in our poll. It has popped up. If it hasn't popped up already on your end, it will only take you 10 seconds. Please give us your feedback. Give us your thoughts on how this session has been. Has it met your expectations? Yes, it comes up right now. And as a participant, has this webinar met your expectations? Please give us your very honest feedback. And how long would you like our next webinar to be? I think we've already given some snippets into our next webinar. We'll probably delve deeper into the risk management matters and as well as the taxation issues. I think, as I mentioned earlier, this is a series of webinars we are running. So be on the lookout for our next one, and let's all learn together. We are all here to impart knowledge on one another. So I would like to invite you to interact with the panelists with our website. Write to us an email, I think corporate@cdsckenya.com. If you have any further questions that you feel you need clarification, reach out to Florence, to Einstein, to Paul, to Timothy, to all the panelists and even the CDSC team for your further engagement, clarifications, and even additional information. So trusting that you have already filled in your poll and you are happy that we are here to impart knowledge to one another. I will now request that we close this session and invite you for our next one in about a month's time. We will share the information and the notice as we approach that date. So thank you very much again, our distinguished panelists and also our participants from across the globe. We really do appreciate that you took your time to participate in this webinar. Thank you very much and do have a fruitful day.
Thank you and good day.
Thank you.
Thank you. Good day.
Thank you. Thank you, everyone. Have a good day.